If you want to become successful at anything, whether it's property investment, business, entrepreneurship, find yourself a mentor, find yourself somebody who's achieved what you're hoping to achieve, and then emulate them. And that's what you're going to get in today's show. So welcome to this week's episode of the Michael Yardney podcast.
Welcome to the Michael Yardney podcast, where each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property advice. Now here's your host, Michael Yardney, Australia's most trusted property commentator, who has once again been voted our leading expert in wealth creation. That's the 5th time he's won a similar award in the last 7 years.
I get interviewed a lot on the radio, television and on podcasts. And today I'd like to replay an interview that I thought brought out some great information, some interesting things about my youth that I've never shared before, some things about my successes, and also the things I've done wrong, because you can learn from other people's mistakes. Why should you make those errors as well? So Mike Mortlock from MCG Quantity Surveyors interviewed me for his podcast, and this show's about double the length of our normal show. If you're a return listener, I'm sure you won't mind, because there's a lot of gold there. If this is your first time listening to the Michael Yardney podcast, well, first of all, welcome, because I know we get hundreds of new subscribers every week. But this is a different format and a lot longer, but I hope you're going to get benefit from it as well. So let's get on with the show.
Michael Yardney, thanks for joining me on Geared for Growth.
My pleasure, Mike.
Now, for anyone that maybe has been living under a rock, could you do us a favour, Michael, and let us know who you are and what you specialise in?
Sure. Well, I'm the CEO, the founder of the Metropole Property Group of companies, and we help our clients grow, protect and pass on their wealth, and we give strategic property advice. Look, we're one of Australia's largest buyers agencies, Mike. We've got our own offices in Melbourne, Sydney and Brisbane, and we've done some sums recently. We've been involved in over $3 billion worth of property transactions, and currently our property management divisions manage close to $2 billion worth of assets for our clients. We've also got a wealth advisory company, project management, renovation division. So it's quite a large organisation, Mike, and it's grown from our home office a number of years ago.
That's pretty impressive, and those are some big numbers, Michael. I'm looking forward, and I have been for a while, of digging into how you got yourself into that position. If we can kick off though with a little bit of, info on the real Michael Yardney. What posters were given real estate on the bedroom wall as you were growing up?
Mike, I actually don't think I had any posters on my wall, but at the time, and actually still, my hobby was magic. So I had lots of books on magic and magazines on magic, and that was, I guess, one of the things that entertained me when I was young.
Yeah, wow. That's interesting. Let's start with your property magic, and there's been quite a lot of that going sort of as far back as the 70s. Can you tell us how you got started in property and what your first investment was?
Well, we came from a reasonably poor background. I came to Australia at the age of 3. I was born in Israel. My parents were workers. And interestingly, a lot of my parents' friends were quite wealthy. My friends' parents, I guess, were wealthy. And I saw that a lot of them grew their wealth. They had their own businesses, but they also invested in real estate, and that's what I knew I wanted to do. And at about the age of 23, I'd saved a bit of deposit. I was still at uni. I was working in Portman's, the ladies' fashion shop in the stock room, picking stock over the holidays to earn money. And when I got a deposit, I got together with my parents and we bought a home in 17 Large Street, a house, 17 Large Street, South Caulfield. We paid $18,000. We took a 30-year loan, had no idea how we were going to pay it off. And Mike, I got $12 a week rent and I was excited. It was really good. Then Gough Whitlam came into power and inflation took off and the property went up in value. And I thought, hey, why didn't anyone tell me about this? This is good. I had enough equity to buy a second one. My mistake was selling both those properties. I sold Large Street for my half share of $32,000, bought it back from my parents in the early 2000s. My wife Pam and I bought it for $250,000. We've since built 2 townhouses on it. So that's initial house that was worth $18,000 is probably worth well over $2 million today.
Yeah, wow, that's quite a story for that little block of dirt. So, what can you talk us through the transition from you being bitten by that real estate bug, seeing that it created wealth for people, creating some wealth for yourself, and then starting your business as Metropole?
Well, I got involved in property investment early. I got involved in property development in the 1980s. Did a few on my own, and then in partnership with a good friend, and started the company Metropole Properties in 1979. The name came from the restaurant where we actually decided to do it. It was a restaurant called The Metropole, and it sounded like a good name. And we did some really, really brave things in the 1980s. Thought I was smarter than I was. The worst thing an investor can do is get it right first time, because you've got an overinflated sense of confidence. And it was really a property boom that carried me away. So got involved in some industrial developments, some land subdivisions, did some big things. Unfortunately, that all came to a halt in the late 80s, early 90s with the recession we had to have. I had a few friends and business partners who went bankrupt in that time. Fortunately, I got through that, but it taught me to be a much more cautious investor, a much more cautious developer. I learned a lot more about property cycles during that terrible early 90s. Middle 90s, I went through my asset reallocation program. I went through a divorce and had to restart again. And one of my friends, one of my mentors said to me, Michael, you're doing well. You've learned how to do this. If you help other people become wealthy, if you show other people, it's going to make you wealthy as well. So I started doing project management for other investors, helping them become property developers. One thing led to another. Pam left her job. We started working from home. And in 2001, we set up property management. 2002, three actually, we started a buyer's agency in Melbourne, 2006 in Brisbane, and 2008 in Sydney. And the business has kept growing from there.
Yeah, wow. And I guess you've got to the point where you can essentially retire some years ago. Was there any sort of formula to getting to that point where you were financially free? Was there something that you struck on, or was it a few mistakes and a few wins that sort of got you there in a haphazard way? Can you walk us through that?
A lot of mistakes, Mike. I'm actually a real success at failure. I guess there's been a tenacity to keep going. Many years ago, I learned the benefit of having mentors and having coaches. So I think one of the big things that has helped my business grow is having external business coaches to help me, and also mentors. And the business that we're talking about today, that is a leading force and award winner in the industry, I planned at a seminar run by Roger Hamilton. Actually, I apologise, it was Brad Sugars. Many years ago in Curran Cove, we went and spent $10,000 each, Pam and I, for a 5-day business entrepreneurial seminar. That was a lot of money in the late 90s. And I put together a business plan, and I decided what I was going to do. And interestingly, a couple of years ago, I came across that bit of paper, and I actually found I'd fulfilled a lot of those dreams. So I set as my goals where I wanted to be, and that meant to have a national presence. It meant to be a published author. It meant to be seen as a leading expert. And then once I set my goals, then I did what I had to do to achieve those goals. And it's actually much the same in any business, or even as in property investment, Mike.
So what are some of the juicier mistakes? I mean, I think that listeners really relate to people that can sort of say, yes, I've achieved a fantastic level of success, but I've really stuffed it up a few times as well.
Oh, look, I've made mistakes in my business life, employing the wrong people. I've made mistakes in my personal life. As I said, I ruined my first marriage, and I've made lots of investment mistakes, but hopefully not too many lately. I think the first mistake I made was selling properties. I thought I needed to sell for cash flow, and I guess I did to a degree because finance was different in those days. Look, I can even remember the first renovation I did. I learned the concept of adding value through renovation. Nobody told me you've actually got to open the windows and open the doors to air and let ventilation come through. So I was painting the kitchen of a property in Bond Street, Caulfield, and made myself terribly sick with all the fumes. So the mistakes are as simple as that to, I guess, early in the piece, not understanding the power of finance, that residential real estate is a game of finance with some houses thrown in the middle. And finance was more difficult in those days, but it's come around again now that we're the credit squeeze at the moment. And not understanding the importance of doing detailed feasibilities. I made some very, very brave calls in the 80s when we did some big developments, but because I thought the boom will just continue on forever. As we got to the late 80s, when interest rates started to go up, I had a very significant commercial property portfolio and about a 70% loan-to-value ratio. And as interest rates went up, the value of my properties went down. And from 70% loan-to-value ratio, 30% equity, I ended up with no equity at all. The values plummeted. Commercial property actually is much more cyclical than residential. And the bank said sell. And I said, who? No one was buying properties in those days. But I have the cash flow to get me through when others didn't. So the banks left me alone while they targeted people who at least were not keeping up with their mortgages. So I learned along the way the importance of having financial buffers, because I didn't at the time, the importance of having a financial strategy, the importance of not having all your interest rates variable because you can get caught out, or all locked in and coming out at the same time, as happened to in a large proportion of my loans in the early 90s in a very high interest rate environment. And I also, I guess, learned that I'm nowhere near as smart as I thought I was, and that every year something is going to come out of the blue, either something political, like would have happened in your industry last year with the tax depreciation laws that changed, something economic overseas or here. And so knowing that despite having the best plans, something is going to come out to disrupt those. But the other is the perspective I've now got that this too shall pass. In other words, the good and the bad times are going to move on, so be prepared for them. Maximise your upside and be prepared to cover your downside.
And I guess this is hard-won experience, and you've witnessed a number of property cycles. What have you seen, and what patterns can you recognise in the property cycles?
Well, interestingly, when I first started investing, the yields on residential real estate, Mike, were around 10%. And in fact, if interest rates were below 10%, you're happy if you had an interest rate with a 9 in front of it. I have always been investing for capital growth, but I have learned over time to recognise the importance of cash flow. I've modelled myself on other people and seen what's gone on also and how they've been successful. And over the time, I've recognised that the cycle can be your friend, and be prepared for the lower part, the down stage of the cycle, the slump stage of the cycle, and take advantage of it. So to be cashed up for those periods of time. I've also recognised that the cycle isn't a particular period of time. I'm sure there's cycles, but there's cycles within cycles. So each stage is its own stage of the property cycle. And then there's different property types, whether it's the higher end of the market, the middle range, the lower end, geographic, apartments, houses. They're all running at slightly different stages of the cycle. But take advantage of the opportunity the cycle gives you. So I fortunately have been had the opportunity in previous downturns to get into property and have a long-term perspective. And by having that, it's made me lots of money. So the one thing not to do is change your strategy because of external factors or because of the cycle. You may change where you invest a bit, but my strategy is to buy high growth properties, areas that are going to outperform the averages because of the demographics, add value to them and hold them for the long term. So I don't chase the next hotspot or the next shiny toy. I've actually done very well by sticking to my strategy.
You make it sound very simple, I guess, but a lot of people aren't following that sort of advice, even if they might sort of know it to be true. People tend to have sort of itchy trigger fingers, and they want to sell to sort of lock in the gain, or they panic if there's something going on in the political markets. Do you think that's a reason why investors aren't hitting their goals?
One of the things I learned along the way, Mike, was that as human beings, we act irrationally. We think we're irrational, but we're not. We act irrationally, particularly related to money. And so I've studied a lot about behavioural finance psychology. See, Mike, when I first started doing seminars, I wanted to educate people. I wanted to teach people what I know. I enjoyed doing that. And I'd have a group of people there, and 100, 200 people would be there. And I don't know, 5% would do something, and 95% didn't. So then I did full day seminars. I had multi-speaker events. I did long events, and much the same happened. I recognised that a small group of people move and do something and the rest don't, or they do the wrong thing. I see that they come to me and they say, oh, yeah, I've read your blogs, I've listened to your podcast, I've followed you, I've read your books, and I followed your strategy, but it hasn't worked. And no, they haven't. They've taken bits and pieces and tweaked it and done what they wanted. And so that we have these biases. People come up and in the old days when I used to go to expos and seminars and say, look, I've just bought a property, and they name a suburb. Do you think it? No, sorry, they wouldn't say that. They said, oh, do you think so-and-so is a good suburb to invest? And I said, you know me, you know what I say. That's not where I'd invest. Oh, but do you think it's a good place? And I said, I bet you just bought a property there, haven't you? So yes, people chase the next hotspot, the next shiny toy. It's human nature. One of the big lessons of successful investors, business people, is to delay gratification. Wealth in property, as in everything else, is the transfer of money from the impatient to the patient.
Well, and we do certainly like to pick on millennials for their lack of delay gratification, but I guess it's something that we all struggle with. You mentioned that your basic strategy is buy good quality assets that are going to outperform and basically hold on to them for dear life. A lot of property experts, they end up landing on a formula. They end up being a development person or a subdivision person. Is there a strategy or a formula that you've used along your investment journey?
Yes, I have. But as I've observed people over the last 40 years I've been in property, I've found that whichever formula you use, 5-10% do really, really well, and the vast majority don't. So a really small group of people do well buying regional properties, but the majority don't. Reasonably small percentage of people do well buying cash flow positive properties, but the majority don't. And really much the same with my strategy of buying high growth property. We know that 50% of people who get into property sell up in the first 5 years, and most investors never get past their second property. So while I have a very firm view on the way to become exceedingly wealthy through property, and you said a moment ago it sounds easy. It may be easy, but it's not simple. And that's not a play on words. It's easy if you follow the strategy. It's not simple because your emotions get in the way. So my strategy is to follow. Actually, I did change over the years. In the past, I used to look at all the research. Now I look forward, and that's actually changed the way my investment results are and those of my clients. So rather than looking at all those, the information you get about what happened to property in the past, I look for future indicators, leading indicators, things that are happening before they change, such as where economic growth is going to be, because economic growth leads to wages growth, leads to jobs growth, leads to population growth, which leads to the demand for property. So we only invest in capital cities, because even though there are opportunities elsewhere, why fight the big trend? Then only in the three big East Coast capital cities, because in general, that's where all the jobs are, the higher paying jobs. And we've changed from being a manufacturing country to really being a service industry country. Then within those states, those capital cities, only in the capital cities, I should say, we invest in the suburbs with the high wages demographic, people who've got higher disposable incomes. Now, I know some people say buy below median price, but my strategy is not to look for affordable properties because they're cheap, but to look for properties that are affordable because the demographic in the area has got a higher disposable income and are prepared to and are willing to pay a premium to live in those locations. And in general, they're close to the CBD, close to the water, the inner and middle ring suburbs of our CBDs, not the inner CBD, but the inner and middle ring suburbs of our cities, Mike. And then in those properties, I find those locations, because location probably does about 80% of the heavy lifting, I buy the right property, an investment grade property, and in particular ones to which I can add value through renovations or development. So by having this structured approach, it has allowed us to weather the ups and downs of the cycle. And sure, we've missed out on the occasional hotspot like Hobart last year. No problem. This year's hotspot becomes next year's not spot. So I'm very comfortable with our strategy.
Yeah, and I guess that it's great to post a 20% growth, but if you are looking at a long time horizon and we're comparing that over 30 years, who's to say that there isn't a suburb in Melbourne that's going to do twice as much, I guess?
Well, we've got 30-year records, so our research department goes back and we've got all these records from the REIA, and so we can tell you suburb by suburb what has happened over the last 30 years. And very, very clearly, Melbourne has been the best performing property market overall. There's no doubt that some segments of other suburbs of cities have done better than the poorest performing areas in Melbourne. So I'm not saying Melbourne's the only place to invest, but very clearly the inner and middle ring suburbs have performed better than the outer suburbs, not as much in the last 10 years or the last 5 years, but you can't tell me that in 20 years' time, Parramatta, no matter how big it develops, is going to be, the land underneath the building there is going to be as valuable as Darling Harbour or Bronte or Bondi, or in Dandenong in Melbourne, it's going to ever be close to the beach in Brighton. So though, if investors think like home buyers, because it's really home buyers that drive our markets. If you were a home buyer and money was no object and you could invest or, live wherever you wanted, in general, people would want to live close to the amenities, close to the CBD, close to all the action is, where the transport is. And that's going to become more and more important in the future, Mike, as our cities become bigger. So those are the areas that are going to outperform in the long term.
Yeah, I guess I can't argue with the Parramatta analogy. That's for sure, as hot as that market is. Michael, what about people that have, say, a limited budget for their property investing? You're talking about targeting areas that have high disposable incomes. Presumably, they also have a pretty high cost to get into those markets. Is that a case that we should save till we can get enough funds to buy in these premium suburbs, or are there still opportunities? Is it not necessarily we're needing $1 million to invest?
Okay. Well, when you buy an investment property, there are three things to play with. There's the budget. That's usually set by the banks, and at the moment that's a bit harder to get. There's location, and you can't compromise on that because that's going to make the big difference. And then the property and the location. So I would rather buy a one-bedroom apartment in a better location than a house and land in an outer area. But currently at Metropole, when we see a client, where we suggest they invest depends really very, very much upon their budget. So if I can give some examples, Mike, we're currently looking for two people for families for blocks of apartments. So if people give us $3 to $6 million, that's the sort of thing we'd be suggesting for them, those old blocks of apartments in Sydney or Melbourne with the potential to do up because they're irreplaceable. Then if their budget is $1.5 to $2.5 million or so, we involved currently in 54 development projects, helping our clients buy an old house close to land value, pulling it down and acting as their project manager and helping them build 2 townhouses, a duplex, which they'd keep in the long term. If they've got $1 to $1.5 million, we're sometimes buying even new properties, new townhouses in good locations because the location is important. Or we're buying still, there's great opportunities in the $800 to $1.5 million in Sydney for well-located properties. In Melbourne, what we're tending to buy is properties with a land component because apartments aren't doing as well, so we tend to buy the older villa units. And I'm coming to your question because what do you do if you've got different budgets? Because even if you've got less than that, between $550 and $657, you can actually buy a house in a great suburb in Brisbane and have the whole land there and basically be in a good location in an inner or middle ring suburb. And below about 500,000, from 400 up. We're still buying one-bedroom apartments in Melbourne, but interestingly, all the ones we've bought in the last little while have been ground floor ones which have had courtyards. They're pretty special, they're a bit unique, they're a bit different. Below the 400,000, I know people are buying things. We have chosen not to. Our business model is not to help everybody, but to help people who want to follow our strategy of buying the sort of properties that are going to be in continuous strong demand in the long term. So my advice, and I actually only sent that in an email to somebody today who said, I haven't got 400,000, what should I do? And I said, sometimes the right thing to do is nothing. Just wait.
Right. I find that really interesting that you would rather buy a one-bedroom place in a good area than, say, a lovely new four-bedroom place in an area that doesn't have those fundamentals. And, yeah, interesting that you're standing by your strategy and you're happy to say, look, we're not the people for you. Just speaking of clients, I know you like to ask three things before you work with them, and that is what's their financial position and their budget, what's their goal, where they want to be in life, and then what's their risk profile. And then I guess you look at their time horizon. So someone in their 50s might be a little bit more urgent to get to their retirement goal than someone in their 20s. Is that how you would generally start strategizing for a client?
Well, interestingly, our model is that we do strategize first. That's really, really important. So while we have a buyer's agency, all clients see a property strategist first, and the strategist asks those sort of questions. The one you've left out, though, is a bit about their risk profile as well. In other words, sorry, you did mention that. I apologize. So really, we want to understand where they are now, where they want to get to in the future, and what they've done in the past, because why haven't they already achieved it and what's held them back? For many people, it's a fear of debt, but it takes the average property investor 30 years to become financially independent, Mike. The first 10, 15 years, they have to learn what not to do. Now, they shouldn't have to do that, but they seem to need to do that. They put their ladder up against the wrong wall, and so every step they take takes them further away. They buy cash flow positive properties, they try and flip properties, they buy regional properties, and then they miss out. So then they've got to unravel that, and then it takes a couple of good property cycles to help them grow their wealth. So the longer time horizon they've got, the better it is. So look, for some of our people who ring us up, most we can do them is give them the recommendation to buy one of my books and educate themselves, because they're not in the position to do anything at all. So I'd rather them educate themselves. For other people, we do a wealth plan. We have a financial planning arm as well. So sometimes they need a strategic strategy. That's a double word, but basically to help them know where they're heading, and then a plan to follow it through. And then through our buyer's agency, we will help them implement that plan, Mike.
Michael, I know a lot of people ask you why you're still working, but there's work and then there's having the number one property blog, writing 8 books, hosting a podcast and wealth retreats. You fill up a lot of your life with this. I'm wondering, are you really broke or really passionate? It's got to be one or the other.
Well, Michael, people say to me, now that your candles cost more than your birthday cake, why are you still doing it? Well, I'm sitting here talking about property and having my coffee and getting paid for it. I'm not getting paid for this, but for what I do. Otherwise, I'd be sitting in the coffee shop downstairs having a coffee and talking about property and not getting paid for it. So why not do it? But I think I can maybe explain it in a better way, Mike. May I?
Yeah, of course.
I remember reading recently that Mick Jagger, the Rolling Stone, was touring America. He's 74 years old and he's doing a multi-city tour of America at the age of 74, turning up at one city, performing, leaving, and then going on to the next place. Now, I suppose that should be reassuring for me. It suggests that maybe in 9 years' time, I might still somehow or other be able to get up on stage and deliver my seminars. But over the years, I've worked hard so that now I don't need to work for financial reasons. But I think I'm still enjoying doing it. And I think I'm still going to enjoy doing it when I'm 74, just like Mick Jagger does. As far as I know, Mick's got no unmet financial needs, but he's still touring largely because he's got nothing better to do. I think a more constructive comment would be he's still touring because he's got nothing else to do for which he's got comparable enthusiasm. So you're right, Mike, it's my passion.
There you go. I'm sure Mick has blown a bit of cash over the years, but I'm sure that the royalty checks are keeping him warm at night. He, of course, doesn't need to be doing it like yourself. I want to talk a little bit about these people that are starting out investing, and maybe these are people on the periphery of maybe not having the budget to work with you, or maybe they've saved a bit of money. The getting the first investment right, you mentioned, can sometimes be a bit of a curse because you've got the confidence, but a lot of people get it wrong, and that really stops them from ever going any further. It stops them from being a multi-portfolio investor. How important is it that one is actually right?
It's critical, Mike. The statistics from the AHRIU show that 50% of people who buy an investment property sell up within the first 5 years. Interestingly, 20% sell up in the first year, Mike. So they've got the wrong finance, they've bought the wrong property, they've overcommitted themselves, they've got scammed, whatever. And of those who stay in property, so of that 2 million Australians who actually stay in property, according to the tax department, there's 19,300 odd people. That's it, 19,300 who own 6 or more properties. Interestingly, when we were talking about those statistics at work, one of my team said, but hey, a huge percentage of the clients at Metropole have more than that. And that made us feel good. But the answer is 92% never get past their second property. So most property investors fail. They fail to get the financial freedom they want because they're doing it to get choices and freedom in life. So if you get the right property, it's the springboard to moving forward. And if it's not, it's the demoralizer that stops you moving forward, Mike. You're right.
Part of the problem, I think, is that the talk tends to be more around the hotspot. I know you mentioned that people were coming to you at expos talking about hotspots. Why do you think investors are wanting to talk first about the property rather than the strategy or the goal or the plan?
Well, I think firstly, most people think they know a bit about property because they've lived in one, they've rented one, they've lived with their parents in one, so they think they know it. And knowing your local area isn't the same as knowing the property market or understanding the fundamentals of property. So most investors get into the market not understanding about finance, about economics, about demographics, about all the factors that drive the property market. But the main reason is emotion. They're emotionally involved. People sort of fall in love with the concept of buying property, and they're sort of twisted. They buy close to where they live, close to where they want to retire or holiday. Now, Mike, that's what I did. That first property I bought in Larch Street, Caulfield, that we spoke about a while ago, when I got involved in the 1970s, there was no data, there was no research, there were no internet blogs. So I bought close to my school, where I had gone years before, close to where my mum went shopping, close to where I lived. I just happened to luck out because it was the suburb of Caulfield, which had a great demographic and was going through gentrification. But today there's no excuse to get it wrong. The trouble is there are so many people vying for your attention. There are so many fake experts on the internet saying, come to my seminar and you can buy 7 properties in 7 minutes, or you can do it without any money down or with your lunch money, and or you don't even need to own a property. Just do something fancy with Airbnb and you'll become a millionaire overnight. And these scams get people's greed glands going. Again, as I said before, wealth is the transfer of money from the impatient to the patient.
I think that's a good quote. Michael, we talked a little bit about some of the strategies that you would have for new investors. When people get to that sort of 3, 4 or 5 property portfolio, do the problems with getting finance, certainly in the current market, necessitate that they change their strategies? Are people hitting the wall trying to sort of revalue, pull equity and go again when they've got a couple of properties under their belt?
Currently, they are, Mike. We're in a credit squeeze at the moment. So we're fortunately in a low interest rate environment. So this time round, APRA and the Reserve Bank to a degree have slowed down our property markets by tightening lending criteria. And while it slowed the market down, that's been a good thing, because if not, we would have continued with the unsustainable growth in Melbourne and Sydney, which would have led to a crash. This time round, we're having a soft landing, so that's good. But it means that some people who could have borrowed more, well, actually most people who would have been able to borrow more a year ago can't today. So it's holding back people, particularly who have multiple properties. one thing that one has to remember is that property investment is lumpy. So we review our clients every year, and if there's something they can do, they can, and if not, they really should just be sitting back and hibernating, going and living their lives and coming back a year later to see if they could do something. So the worst thing to do is change your long-term plans because of short-term market changes and buying a secondary property which is going to not get you where you want to go. That's why you have to have a plan, you have to have an end game, and then you've got to point in that direction. But a lot of our clients, once they've bought a number of properties, the role is to now add commercial properties. You shouldn't do it too early. When you asked about my mistakes earlier, one that I left out was I got involved in commercial property too early, and that's one of the things that almost took me down in the early 90s because they're much more cyclical. When they're vacant for much longer. But they're also a high yield investment. And it is important as you grow your portfolio to start lowering your loan to value ratios and getting more yield. So in my mind, there are three stages in the investments journey. Stage one is asset accumulation. You've got to accumulate a large asset base, then slowly lower your loan to value ratio, stage two, and stage three, living off your property portfolio, whether it's off the rents, off the equity, whichever strategy works for you at the time. So as one matures in your property journey, adding commercial properties with reasonably comfortable loan to value ratios helps the cash flow as well, Mike.
Yeah, and I guess those yields are going to help you to pay down the debt on that property and maybe other properties in the portfolio as well.
Yes.
If there's one thing that you could put your finger on as a mistake that you see property investors make, if there's one sort of takeaway where you'd love the world to stop doing one particular thing, what do you think that would be, Michael?
Well, we already mentioned it, not getting enticed by those get-rich-quick schemes. In other words, thinking that I'm going to buy a property and then it'll pay for my school fees, or I'm going to buy a property and I'll go away on holidays, or I'm not going to have to do anything, it's set and forget. Not at all. And I guess if I could throw in a second mistake that people make, and we've mentioned it a bit before, is looking for information that validates their own preconceived ideas and dismissing any input that conflicts with your reasoning. So educate yourself, learn, but be really careful who you learn from. And if you've got a particular idea, just be careful and look at the contrary and see, is it possible that I'm wrong?
Yeah, I guess that's a really important idea, because you could imagine someone saying or thinking Dubbo is where I want to invest. It wouldn't take much Google work to find someone who says Dubbo is a great investment, but the majority of people might be saying that it's not. Now, I don't know particularly the market dynamics of Dubbo is just an example, but we certainly do look for confirmation of our biases. Again,
that's knowing your local area, which is not the same as knowing your property market. And yet it may mean that you could find a bit of a bargain because you know that Aunt Mary down the road is selling and she's going through a divorce and has to sell quickly, but that doesn't mean that you're going to have a good investment. The short-term one-off profit isn't where you make your money. You make your money when you buy property, not because you buy cheaply, but because you buy the right property.
Yeah, I guess the enticement of getting a snappy deal is really outweighed by the returns over 30 years if there's nothing there.
That's right.
You mentioned that you're project managing a lot of developments for your clients. How important have developments been for your personal strategy?
Well, it's something I got involved with in the 80s. And interestingly, I learned a lot then because I got through a few developments and made money. But at the end, when I looked honestly, I made money because of a rising market. If I made those same mistakes today in the current flat market, I'd go broke very, very quickly. So I've learned and I've honed my skills and I've improved what I'm doing. So developments did get me going and helped grow my wealth faster and quicker at sort of buying properties at wholesale. It's one of the most common reason people approach us at Metropole because they want to become a property developer. But most people can't because it takes a lot more money than you think you need and a lot more serviceability, and it's definitely not for beginning investors. I believe you've got to cut your teeth, owning a couple of investments, doing some renovations, having some successes and having a few failures, because development's a longish process and you're fighting with councils and neighbours and builders, and even though you use us as project managers, there are emotional ups and downs. So it's not for the faint-hearted, but it's been a great way of doing things. Look, recently I was looking at buying a commercial property. It was a pharmacy in Church Street, Brighton. It was an auction of a great a trophy property that hadn't been sold for 40 years. And I was telling Bryce, my son, who runs our development division, I said, hey, I'm actually thinking of going for that at auction. And he was smart. He said, Dad, just do the numbers, do the figures, do the sums. Look how much more you make out of projects and getting a project and doing a development. And so there was even my emotions running. While, I would love to own that and say I own that big. It was at least to a pharmacy. The pharmacy had nowhere to go. It was somewhere that hadn't been sold for 40 years. And in fact, some lucky investors bought it. But I've done even better by putting my money. So I don't own the trophy, but I own some great investment properties that are working hard, giving Pam and me the lifestyle we enjoy.
It's nice to see that even with your experience, you've still got this little emotional monster inside making you or suggesting that you make impetuous decisions that aren't actually sort of aligned with your strategy.
Oh, yes. I still get sidetracked and emotional. We're all human. And that's one of the reasons I have mastermind groups and mentors and business coaches. I spend over $100,000 a year on business coaching, but I see that as an investment. And that's one of the reasons I've always run a mentorship program to help other people. It's an investment that I worked out get about $30 for every dollar I spend on it. It's a huge return that I couldn't get any other way by having people see my blind spots, have transformational conversations with me, Mike.
Yeah, wow, that is a good ROI. You mentioned just a moment ago that renovation is maybe a better strategy for the people that don't have the wherewithal or the budget to get into developments. There's a plethora of renovation shows. There's a lot of buzz around it. Is it still a great way to get a quick equity and yield boost, or are we better off ignoring those shows and looking at established properties that are going to perform over the long term?
Okay. Well, a lot of developers started off renovating. So if you're planning to become a developer in the future, it's a really good learning ground. The answer is renovations are a good way of adding value, but they're not a way of making quick money to flip. Even the block, if you actually took all the numbers and figures into account and the interest involved in in holding costs, they don't make any money doing the flip. So renovation, my strategy is buy, renovate, rent out, refinance, and repeat. A Brewer strategy, as opposed to buy and flip. That doesn't work unless you do major structural work, which to me then isn't a renovation. And on that basis, all you've got to do is pay stamp duty and start all over again. So if you buy an older property and you can't afford to renovate now, no big deal. Get the best property you can today, because the potential to add value and renovate is going to be there in the future. And that gives you good depreciation benefits. It makes it more attractive to a wide range of tenants, therefore getting you a better rent. And it manufactures capital growth, a one-off capital growth. So you've still got to have the underlying fundamentals of the best property in the best location you can afford, Mike.
That's interesting. Yeah, I appreciate the insight into that, and certainly something that we've seen some of our clients do very well at. And as you mentioned, great for depreciation as well. I want to talk about mindset. It's very clear that it comes out in your blogs and speaking about the emotional decisions and about, I guess, the barriers to success. How important is mindset as a part of your coaching, whether you're mentoring people or they're coming and working through your business?
Well, it's interesting. It's also an important part of our team and how we help them. And a short while ago, we were in Wealth Retreat, which is Australia's high-end property and entrepreneurial workshop, where people spend $10,000 to spend 5 days with us. And most of these people are already very successful business people, investors and entrepreneurs. And the first 2 days are all about mindset, understanding their limiting beliefs, understanding what's held them back, and getting rid of those limiting beliefs and taking them to the next level. Because unless we do that first, Mike, all the tax, finance, property development, other strategies, business strategies wouldn't help them. Because we are think we're rational, but we're not. Our brain is, I'm told, 2 million years old, and it's basically there to prevent us getting into trouble. It looks for safety. We have all these cognitive biases. So as property investors, we're often our own worst enemy. So that's why behavioural finance, psychology is really important to me, because it's not the decisions we make and the opportunities we consider or the investments we miss out on, but it's the way we think that gets us into trouble. These biases, our brain sneakily hides, makes decisions for us that interestingly are not necessarily in our best financial interest. These biases get us to spend more, save less, feel more confident in our decisions than perhaps we should be. The scary thing is, in the most part, this all happens at the subconscious, unconscious level. We're not even aware of it. So it's a very, very big part of my teaching, because when you turn up your financial thermostat, it gets you to the next level. Maybe I can explain it in a different way, Mike. I believe if you took all the money in the world and distributed it equally, it'd be back in the same proportions, the same pockets in, 3, 4, 5 years' time. Would you agree with that?
I think you're probably right, yeah.
And the reason is because if you suddenly get a windfall, such as a property success, an inheritance, tax lotto, and you haven't grown to be where you want to be the person who can handle that money, you're going to lose it. So I often say that you're not going to be able to drive a Ferrari with the mindset with the engine of a Hyundai. So you've got to grow to be a better person, and not better in other ways. It's not denigrating you as the value of a person, but your headspace has got to be at the next level. So if you see the millionaires, the billionaires that we deal with, if they go broke, and they do, all business people have a bad time, they pick up again, they get going again. While the average Australian's headspace is basically set at having a net equity of a few $1,000s, and if you give them more, they're just going to find a way of spending it.
I think that the lotto is a great example. I'd love to see the stats of what the people that win a big windfall, maybe a couple of $1 million, what they have left after 10 years. I think you're right, as that we've got to learn how to not be emotional and to plan, and people aren't really prepared for that. Do you think that's a big problem with the innate nature of a person and the nature of investing long term?
Mike, I have seen that with people who've inherited money. I've actually never come across somebody who's won the big lotto, but I actually have seen people who've got inheritances of hundreds of thousands of dollars and a few of millions of dollars, and then the brothers and sisters argue and fight about it, and then they sell the good property that they should have held on to, or they spend lots of money and have a holiday and give some away to this person and that person, and then come back to us and say, "Oh, I've got 200,000 left. What can I do with it?" Well, why didn't you come to us when you had 2 million?
Yeah. Yeah, that's absolutely crazy. You think about what you could do with 2 million compared to 200,000. Michael, can you walk us through some of the services that you offer? So if someone gives your office a call and they're wanting to grow their portfolio or start a portfolio, what are some of the ways that you help them out?
Well, we first of all, as you said a bit earlier, and understand where they are, where they want to be, and if we can help them, because our services don't suit everybody. So they're going to have to want to own property and also be happy to follow our strategic way of thinking, but we're going to give them good sound reasons and information as to why. So the first thing is to have a strategic consultation and create a wealth plan for them. We also have a wealth advisory business. Ken Race, my business partner in wealth advisory, is an accountant, a financial planner, and so some people need the right structuring and financial planning. We've got a buyer's agency that implements the strategies, and our own teams in Sydney, Melbourne and Brisbane. So rather than fly in, fly out, and you never get the right perspective. You can do all the homework, you can do all the research on the internet, but the one thing that you can't get on the internet, Mike, is perspective. So our wealth strategists, our property strategists, interestingly don't come from a property background. Our National Director of Property Strategy, Kate, she comes from, she's a CFA and comes from an investment background. Rita, one of our property strategists, is 30 years ANZ banking history, a commercial banker. Bretton's, my business partner in Brisbane's got a economics degree, as is Ahmed in Sydney. So the people who give you advice give you wealth advice rather than property advice, with property being the vehicle. And then the buyer's agents, they've got the property history. They're ex-sales agents. So we don't employ enthusiastic amateurs. We employ people who've got a huge network of contacts. In Melbourne, more than half the properties we buy are off market because of that network of contacts. Then our other services include adding value through renovations. Our renovation division last year did 70 renovations for clients, and
wow.
Our development division. So our strategy is to buy a property and add value through renovations. Our property management division, the same property managers that look after my assets would look after yours, and they do it smartly. We look after close to $2 billion worth of properties under our property management division. But we then don't leave our clients. It's not transactional based. We really want to have a long-term relationship, so we do annual reviews. And then, of course, there's all the educational things through the blogs, the podcasts, the seminars. So it's quite a diverse company over 3 states with just over 50 people involved.
Wow, it's quite an operation. It sounds like you've got all the bases covered there, Michael.
Took a long time.
How do people get in touch with you or your team, or if they want to make a connection with you?
Sure. Well, 1300 Metropole, the name of the company, or metropole.com.au, or if you just do a search on Michael Yardney, Google will come up with all clever ways of getting in contact with us.
Good old Google. Now, Michael, this might be a tricky one and maybe something that we've already covered, but if there's one piece of advice that you could impart, one takeaway from this podcast, what do you think that might be?
Mike, I've said it twice, but if you allow me, I'll say it a third time. Wealth is a transfer of money from the impatient to the patient. So learn delayed gratification. What you do today will get you to where you need to go tomorrow. So set a plan, set a goal, and be patient, because residential real estate isn't a get-rich-quick scheme, Mike.
Fantastic. I think that there's a bit of science to say if you hear something 3 times, it's more likely to sink in. So that's our gift to you, listener. Michael, it's been an absolute pleasure. Thanks very much for joining me.
I've had lots of fun, Mike.
Beautiful. Have a great day.
Thank you. Wow, that was a much longer show than normal, but I hope you got some benefit from it, learning about my journey, the things I've done right, some of the things I've done wrong. If you've enjoyed it, why not click the share button on your podcast app so that you can pass it on to somebody else? And I look forward to being back with you next week with our normal format show.
Thanks for listening to this week's episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect and pass on their wealth through strategic property advice. If you got value from today's show, we'd really appreciate it if you would leave a review, and we'll read it out on a future show, and Michael will gift you one of his books as a way of saying thank you. Just go to michaelyardneypodcast.com/review and let us know what you think. If you don't already subscribe, head over to iTunes or your favourite Android app. You'll find us there as Michael Yardney Podcast. If you'd like to gain instant access to the show notes, head across to michaelyardneypodcast.com. Watch out for our show next week. You'll learn some new ideas about property investment, success and money in around 30 minutes.